Okay. Good evening, everyone. Good evening. How are we all? Good going? Okay. So now this session, we will be partly discussing about the last part of the uh, in the capital structure, and then of course we will be taking up the topic of concern for today, which is capital structure. Sorry, for the which is the leverage. So right now, let us focus on completing the remaining part of capital structure. Uh, that part is essentially about the Modigliani-Miller arbitrage model. So let us have a look at it with the help of an example for better understanding. Let us say there are two firms. One is a levered firm and another is a unlevered firm. So one is a levered firm and another is a levered firm. Levered and unlevered. So we know, what do you mean by the levered firm, by the way? Yes. What do you mean by levered firm? Levered firm means a firm which is having, it means a firm which is having debt in its capital structure, right? And unlevered is a firm where there is no debt. Okay. Levered firm is a firm where there is debt in its capital structure. Unlevered firm is the one where there is no debt in the capital structure. So let us say levered and unlevered firm, we say both are having EBIT or earnings before interest and tax to the tune of let's say 1,20,000. Okay, so levered is having 1,20,000. Even unlevered is having 1,20,000 as the EBIT. From that, interest is being paid, let's say 30,000. And of course, since it is unlevered, you don't have to pay any interest. So profit before tax turns out to be 90,000. And in case of unlevered, your profit before tax will still continue to be 1,20,000. Now, interest that is being paid is, let's say, at the rate of 10%. Okay, so we can say, let's say, cost of equity or KE is going to be for levered, let us assume it is 15%. Okay, so this we get the value of equity as PBT upon K. So 90,000 divided by 15% gives us the value of equity as 6 lakh. Okay, and of course the value of debt is going to be 3 lakh. So we get the value of the firm as 9 lakhs, which is total of value of equity and value of debt. So total of value of equity and value of debt, 6 lakh plus 3 lakh. Value of firm turns out to be 9 lakh. In case of unlevered, KE is, let's say, 12%. Okay, or for that case, let me just assume KE to be, wait, okay, KE to be, let's say it is 14%. So if the cost of equity is 14%, we can get the value of equity as 8,57,143. There's no value of debt. So the value of the entire business is 8,57,143. Okay. Now, out of these two companies, which company is having overvaluation? Which company is having overvaluation? Levered company, right? So levered company is having an overvaluation because it is having a value of 9 lakh, whereas unlevered is having a value of 8,57,143. So now tell me, with this levered and unlevered aspect, we have to do something called as arbitrage. Have you heard of this term arbitrage earlier? Have you heard of this term arbitrage? ARBITRAGE. Have you heard of this term arbitrage anytime before? Yeah. Are you aware of this term arbitrage? Yes or no? Hmm? Anytime you've heard this term arbitrage, what do you mean by the term arbitrage if you know about it? No, not aware. Okay. Now arbitrage is a simple thing wherein you are going to arbitrage is pretty simple because what we do is you are simply going to identify the market where a particular thing is undervalued and another market where the particular thing is overvalued. For example, 1 kg of potato in market A, it is 15 per kg, and in market B, it is 12 per kg. So looking at this, what will be the instant course of action that you would think of carrying out? Yeah. Looking at this thing, what will be the instant course of action? I mean, instantly you will say that, let us do this. What will be the course of action that you will do? What will be the instant course of action that you're going to do? Yeah. You're going to purchase from B and sell it in A, right? So just we are just not considering the transportation cost because it may be negligible for us. But ignoring the transportation cost, the simple activity is you are going to buy over here and you're going to sell over here. So you're going to buy in B and sell in A. You're going to buy in B and sell in A. So you can say you're going to buy in B because it is undervalued, and you're going to sell in A because it is overvalued. So simple thing is you're going to buy in the market where it is undervalued and you're going to sell in the market where it is overvalued. Got it? Everyone? You'll be buying in the market where it is undervalued and you're going to sell in the market where it is overvalued. Are we clear? Yes. So similarly, if you look at these numbers of levered and unlevered, tell me where are we going to buy and where are we going to sell? I mean, which company we should be buying and which company we should be selling? Which company you should be selling and which company you should be buying? Of course, we are going to place a buy order in the unlevered company and sell the levered company. So it means our investor is going to sell its stake in the levered company and buy the stake in unlevered company. Correct? Yes or no? Perfect, everyone? Yes or no? Because arbitrage is simply buying in the undervalued market and selling in the overvalued market. So you're going to buy the unlevered company and you're going to sell in the levered company. Correct, guys? Okay. Now, so over here, we will simply say we're going to buy in one place, we're going to sell in the one place. Let's try to carry out that transaction one by one. So first step, obviously we are going to make an assumption because without that assumption, no calculation is going to hold true. So the first calculation assumption is, let's assume an investor with 10% stake in levered company. So let's assume an investor with 10% stake in levered company. So let us assume that we have an investor who is having 10% stake in the levered company. So what will be the cash inflow by selling 10% stake in levered company? Yeah, tell me. What will be the cash inflow by selling 10% stake in the levered company? How much cash inflow are we going to get? Because see, you are holding 10% of the shares. So 10% in the levered company shares, let us say. So the company, you're talking of 10 levered company shares. So when you sell 10% of the shares of levered company, what is the amount that you're going to receive? Can I say it will be 6 lakh into 10%? Right? Which is 60,000. So as an investor, you're going to receive 60,000 in your bank account when you will sell your shares of the levered company. So when you sell your shares of the levered company, you're going to get 60,000 as the cash. Are we clear? Right? Everyone? Because you are holding 10% of value of equity. So of course, you're going to get 60,000 as a cash inflow. Now, what are we going to do with this 60,000? What are we going to do with this 60,000? Yep. Tell me guys. What are we supposed to be doing with this 60,000? Of course, we need to invest that money because we have sold. Perfect. Anil, and I think Anu and also Bhupati. Yeah. So we'll take the 60,000 and put the money in unlevered because our arbitrage strategy is simple, that you shift from levered to unlevered, or you are going to sell the overvalued and invest in the undervalued stock. So we're going to invest 60,000 in the unlevered. But before we go for investing in unlevered, tell me one thing. Is your 60,000 investment in levered and 60,000 investment in unlevered, is it having the same amount of risk? Because unless and until we match the risk and investment, we can't compare the return. Because if you're earning high return by taking high risk, of course, there is difference. You can't say that I invested the same 10,000, I got 12,000 by taking higher risk. So risk is different. Where do you see the risk is higher? As an investor, if you put your money in levered or unlevered, where do you see that this 60,000 is going to be invested in a risky proposition? Yeah, where is the risk? Where is the high risk? Where do you see there is a higher risk? Where do you see that there is higher risk? In levered or unlevered? In which company your investment is at higher risk? In the levered company or in the unlevered company? In the levered company or unlevered company? Of course, levered company, because levered company against your 60,000 in the levered company against your 60,000 investment, right? In the levered company against your 60,000 investment, company also had certain amount of debt. In the levered company, you can see equity shareholders have invested 6 lakh, but company has also borrowed 3 lakh. Can I say this 3 lakh is definitely the debt of levered company? The ultimate, liability will fall on the equity shareholders, right? So this 6 lakh equity was subject to a debt of 3 lakh, or this 6 lakh of equity investment is actually subject to 3 lakh of debt investment, right? So now when you take 60,000 and invest in unlevered, can I say earlier this 6,000 was actually carrying a debt of, this 60,000 was actually carrying a debt of how much proportionate amount? If 6 lakh equity had a debt of 3 lakh, how much debt was indirectly on this 60,000 of equity? 30,000, absolutely correct. So if I just take this 60,000 and invest in unlevered, can I say I'm going from a high risk company to a low risk company? Right? I'm going from a high risk company to a low risk company. Correct, guys? Yes. So how do I make up for that? Because then the returns are not comparable. So what we will simply do is borrow 30,000 for matching risk of previous investment. So we're going to borrow 30,000 for matching risk of the previous investments. So whatever where your previous investments, you're going to match the risk by borrowing 30,000. Now once you borrow 30,000, you have already taken 60,000 from the market. Now tell me, what is the total money that you have? How much is the total funds that you have? Total funds available for investment is how much now? Because you got 60,000, right? So you got 60,000 by selling the shares of the company, shares of the levered company. Again, you borrowed 30,000. How much balance is there in your bank account now? How much will be in the bank account? Of course, 60 plus 30, you have got 90,000. Total money that you have got in your bank account is now 90,000. Now, also, before we check, we are getting any extra return or not, I need to see what was my percentage stake in the levered company. How much percentage of the company I was owning when I have invested in the levered company? When I've invested in the levered company, how much percentage of the company had I owned? 10%. Now, when I'm switching my investment to unlevered and I want to see whether there is any additional gain or not, how much percentage ownership should I get in the unlevered company? Same 10%, right? So we'll say money required for 10% stake. Money required for 10% stake in unlevered. Because unlevered value is 8,57,143 into 10%. 8,57,143 into 10%. So I need 85,714. How 90,000? You had already got this 60,000, right? And we are going to also borrow 30,000 for matching the risk, because earlier company was having a 30,000 of loan against my equity of 60,000. Now I will take 30,000 of borrowings. So this 30,000 plus the 60,000, so total 90,000. Is it okay? Okay. So money that we need for 10% stake in unlevered is only 85,714. Now, what is the balance or surplus money left with us? Surplus money left with us. How much is the surplus money left with us? Can I say it is 90,000 minus 85,714? So what is the surplus that we have? 90,000 minus 85,714. We have 4,286 rupees. This is the surplus money that I have. Acha, what is the rate at which I can invest this 4,286? Bare minimum, I can invest it for risk-free rate. Can be invested for at least risk-free rate, right? So we can definitely, invest at least a risk-free rate inside it. Now, let us see what are our earnings in this case. So earnings in unlevered. Since I'm going to have 10% stake in the unlevered company also, at least risk-free. Daksh, it is at least risk-free you are going to get. Okay, so earnings in unlevered. Earnings in unlevered. Earnings in unlevered. How much is the earnings going to be? Earnings of the unlevered is 1,20,000 for all the investors. So of course, for unlevered, it is going to be now 1,20,000 into 10% because we own 10%. So it is 12,000. So earnings in unlevered is 12,000. Okay. I need to check whether by investing in unlevered, I am making any gain or not. So I'll say, what were my earnings in levered entity? But wait, before I go ahead with the unlevered final number, I need to also subtract interest to be paid. Since I have borrowed, 30,000. So on that 30,000, I'll be paying interest at the rate of 10%, which is 3,000. So I'm having an income of 9,000. Okay, so earnings in unlevered is 12,000. So interest that we need to pay is 3,000. So the balance that we are left out is 9,000. So that's our income in the unlevered. Now I need to check what was my previous earnings in the levered entity. Previous earnings in levered entity. So what is the amount of previous earnings in levered entity? In levered entity, we were getting 10% of the final profit, which is 90,000 into 10%. So 90,000 into 10% is 9,000. So when I've invested in unlevered in the new company, you are getting a net profit of or net benefit of 9,000. Earlier also you were getting 9,000. So tell me, is it beneficial for us? Is it beneficial for us to invest it in the unlevered company? Are we getting any benefit by switching our investment from levered to unlevered? Yes or no? If yes, then what is that benefit? Because the earnings is still remaining same. Earnings is still remaining 9,000, 9,000. There is no benefit of low risk. I have matched the risk because I have borrowed. No? I have borrowed that 30,000 to match the risk. The benefit stays over here. See, now when you have invested in unlevered, you're having that surplus money of 4,286. I can invest that 4,286 additionally in some market, and I will be able to get at least some 5% or 6% risk-free rate. At least I'll be able to realize some of them, 5% or 6% risk-free rate. Yes or no? Correct, guys? Right? So, as an investor, would you like to switch from levered to unlevered? Yes or no? Would you like to switch from levered to unlevered? Of course, yes. Now, if it is yes, what's going to happen if people start selling the levered company shares and they're buying the unlevered company shares? What is going to happen? Yeah, what's going to happen? Can I say the value of levered company shares or value of equity of levered company shares, it goes down and this goes up. And the price of levered company shares is going to go down. Price of unlevered company shares is going to go up. So to what extent it is going to happen? To what extent it is going to happen? Till you see that both the companies are having the same value. Till the point you see that both the companies are having same value. Okay. So till the point we find that both the companies are having same value, you will find that the value is keeping on changing, right? So you can definitely, if you want, you can obviously invest to this entire amount in the new company. Of course, your returns is also going to be higher because now it won't be 10%, it will be more than 10% stake, right? So this is what your arbitrage is. So arbitrage says that since both the companies are having different valuations, the investors of high value companies are going to uh, sell the shares, right? And the value, I mean, they're going to invest the money into unlevered. And this process is going to continue till you find that both the companies have reached a par or both the companies are at the same level. And when you find that both the companies are valued at the same level, then the arbitrage stops happening. Okay. So therefore, whenever there is a disparity in the valuation of two companies, this model says that investors are going to switch from one company to another company, and that will cause the share prices to fall and rise, and that's going to settle off with each other. Got it? Did you get it, everyone? So this is what is we call it as a arbitrage process. It's a simple process. It's just that the arbitrage is undertaken to ensure that the market prices are, or the values of both levered and unlevered entities are equal. Clear, everyone? Okay, fine. So that is your arbitrage process. Same way, when the unlevered company value is high, investor will shift from unlevered company to levered company. Okay, fine. So that's your arbitrage process. Now, that completes our capital structure uh, topic with this. And now we have to start with the next topic called as the leverages. Okay, let's go for the term or the chapter of leverages. Have you ever heard of the term something called as lever in physics, maybe? Have you heard of it? Lever. Yes. What is a lever, if you have ever heard of it? To balance something, we use lever. Okay. Anything else? To balance something, to open something. Okay. Perfect. To open something. Okay. Okay. What do we really mean by this? Lever. Lever is essentially an activity which is you know uh, or it's a tool by which you make your tasks easier. So, for example, if you look at lever, what is this lever really talking about? Listen, if you have seen, let's say, for example, a bottle opener. So you have let's say we have a bottle. So you have a tool, to open this bottle. So that bottle opener, that is an example of lever, wherein you see that this bottle opener is used to make the task easier of opening the bottle, which you can't open with your bare hand. So you need this bottle opener for opening it. Same way, in gardens, if you have seen like your seesaw, that's also a typical case of lever because in seesaw also you have a load and you have the force coming in over here. So all these activities are essentially done for the purpose of, yeah. So this is done for the purpose of uh, getting the things easier, right? So because you can't push this load with your bare hand, but you can definitely use a lever to uh, you know make the tasks easier. Same way, you can't open this bottle opener with your bare hands. You can't open this bottle with your bare hands, but you can use a bottle opener to use it, right? So this the task of all the levers are essentially to make sure that you're putting less effort, and against that you're getting more results. Okay, so you're putting more, you're putting less efforts and getting more results. So similar activity is happening even in finance. So let me just demonstrate it with you, right? So let us say sales in terms of units. As of now, suppose you are selling 10,000 units and you have the sales value in rupee as, let's say, 10 lakh. the variable cost. So variable cost is, let's say, 4 lakh. So the contribution that you are left out is 6 lakh. Less fixed cost is 2 lakh. Okay, so let's say fixed cost is 2 lakh. So we get a earnings before interest and tax of 4 lakh. You're paying another interest of 1 lakh, and your profit before tax is 3 lakhs. Then you're going to pay tax, let's say at the rate of 30%. So tax at the rate of 30% is 90,000. So your PAT is 2 lakh 10,000. Divide it by number of equity shares. So let's say you are having 10,000 number of equity shares. So we have the EPS of 21 rupees. Okay. So now let us say you put some extra efforts before variable cost. I mean, this is contribution. So sales less variable cost is contribution. Now suppose you put some extra efforts and you push the sales by additional 10%. So now your sales quantity is 11,000. Okay. So can you just complete this entire table and arrive at this EPS value? Can you calculate the revised or the new EPS value? Yes. Can you complete this table? So of course your sales, the earlier it was 10 lakh. Now your sales is obviously going to be 11 lakh because the units have increased, right? So now with that, you can arrive at your revised EPS, right? So just try to calculate the EPS when your sales have increased by 10%. Try to calculate the EPS. Okay. So your variable cost is now 4,40,000. Contribution is going to be 6,60,000. Fixed cost will continue to be 2 lakh. And your EBIT will become 4,60,000. Interest will remain same 1 lakh. So your PBT is 3,60,000. Tax, of course, it will be a new figure, which is 3,60,000 into 30%, which is 1,08,000. And your PAT is 2,52,000. Number of equity shares 10,000, and this is 25.2. So the new EPS that we have is 25.2. So now just give me calculations for what is a percentage change in sales? Tell me. It is still 10%. In fact, percentage change in variable cost is also 10%. Percentage change in contribution is also 10%. Fixed cost has not changed anything. But if you look at EBIT, what's the percentage change in EBIT? What's the percentage change in EBIT? EBIT, how much is the percentage change? What is the percentage change in EBIT? Percentage change in EBIT? Can I say there is 15% change, right? So your EBIT is changing by plus 15%. And of course, the interest is, there's no change, but your PBT is increasing by, what's the percentage change in PBT? Percentage change in profit before tax? Percentage change in profit before tax? 20%, right? So there's a 20% increase in PBT. And if you look at all other numbers, you will find there is 20% change, right? So tax is changing by 20%, your PAT is changing by 20%. Okay. So this is like, EPS is also changing by 20%. So the question is, with a 10% extra effort, in sales, the results in the form of EBIT are seeing a transformation of 15%, and EPS is seeing a transformation of 20%. So of course, with a given level of efforts, you are seeing a greater degree of results. So that is exactly what we okay. That's exactly what we mean by the leverage, right? So leverage is like 10% effort is causing you a 15% of result. Okay. So just like elasticity of demand, you remember elasticity of demand? Do you remember elasticity of demand? Yes or no? Yes. The same way, operating leverage is a type of leverage that we are talking of. So operating leverage is percentage change in EPS for a given percentage change in, sorry, not EPS, my bad. Percentage change in EBIT for a given percentage change in sales. So what's the percentage change in EBIT? It is 15%. Percentage change in sales is what? 10%, and this is 1.5. So operating leverage is 15% upon 10%, which is 1.5. So 1.5, how do we interpret this 1.5? This 1.5 means percentage change in EBIT is 1.5 times of percentage change in sales. Or you can also say 1% change in sales will cause 1.5% change in EBIT, right? So EBIT is essentially 1.5 times sensitive to sales value. So it means you just put 1% effort and you get 1.5% result. So that is essentially what leverage we are talking of. Okay, just like your elasticity, for 1% change in price, what will be the percentage change in the quantity? That is exactly what we mean by over here. The leverage part also. Okay. Got it, everyone? Yes or no? Yes. Okay. Same way, we can also have like the operating leverage. Same way, we are going to also have something called as financial leverage. So financial leverage is percentage change in EPS for a given percentage change in EBIT. Percentage change in EPS upon percentage change in EBIT. So percentage change in EPS is 20%. Percentage change in EBIT is 15%. So what's the financial leverage number? What's the financial leverage number? It is 1.33 times. So how do we interpret this? This simply means for 1% change in sales, there will be 1.33% change in EPS. So for 1% change in sales, there will be 1.33% change in EPS. Okay. Did you get it, everyone? So for 1% change in sales, there's going to be 1.33% change in the earnings per share. Okay. So that's your financial leverage. One more leverage we have, which is called as the combined leverage. Now, what do you mean by combined leverage? Combined leverage is percentage change in EPS for a given percentage change in sales. Percentage change in EPS is 20, and for a given percentage change in sales is 10. So this is 2 times. Right? So combined leverage is 2 times. It simply means that sales changing by 1% will cause 2% change in EPS. So all these leverage numbers are simply telling you what is going to be the impact on the next financial item if you change one of it. So it's like a measure of risk. So when you say operating leverage is 1.5, your EBIT is 1.5 times sensitive. Your EBIT is 1.5 times sensitive to sales. So if you just put some effort and try to generate sales additional just by 1%, your EBIT can be increased by 1.5. So you have that additional advantage. It's not a case that if your sales increases by 10%, your profit will also increase by 10%. No, your profit is going to increase by more than 10% because you have the leverage components or leverage in this 1.5 when it comes to your operating profit, and 2 if it's going to be your final net profit. Okay, it's just like your elasticity that you change. What will the impact on the demand if the price is changing by certain value? Okay, got it, everyone? Okay, so how many types of leverages do we have? We've got 3 types of leverage: operating, financial, and combined leverage. Operating, combined, and operating, financial, and combined leverage. Okay. Now, these leverages are a measure of the risk. That is how much uh, times of your efforts are going to be on the result side. So now my question is, having leverage in your financial statement where you see the impact on your EBIT or impact on EPS is going to be more than what is your impact on your sales. Is it a good thing or a bad thing? Is leverage a good thing or a bad thing? Yeah, tell me. Is leverage a good thing or a bad thing? It's both. Because if you are having an advantage with 10% increase sales, trust me, you're going to have a disadvantage also if your sales fall by a certain percentage. Because if it can increase, if your increase in sales can cause a substantial increase in EPS, of course, a decrease in sales is also going to cause a substantial decrease in your EPS. The decrease in your sales is also going to have a substantial decrease in your EPS. So it's good as well as bad. Now, what is something that's good as well as bad? That's nothing but risk. Risk is something, if you can manage it, it's good. If you can't manage it, then it's bad. Okay. So that is what we are talking of as a leverage. Leverage is a measure of risk. It's a measure of it's a measure of the company's risk. Okay, wherein we can say how far the company is able to uh, use this leverage term to earn maximum returns. So for every percentage change in sales, what is going to be the percentage change in your operating profit? That's represented by EBIT. And what's going to be the percentage change in your EPS? That's going to be your final line. Okay. So let me give you a case and you just try to calculate the operating leverage. So sales is 2 lakh. Variable cost percentage is 50%. Fixed cost is 30,000. Tax rate is 25%. Interest is 20,000. So from this, try to calculate what is operating leverage. Try to calculate what is operating leverage, financial leverage, and combined leverage. Just like we did it in the previous question, just try to calculate the operating, financial, and combined leverage from this. Try to calculate the operating, combined, and financial leverage. Try to calculate the operating, combined, and financial leverage with this data. Number of equity shares. Number of equity shares is, we have the number of equity shares as, let's say, 1,000. Variable cost 50% means, of course, it is 50% of the sale value. What will be the second sales? You can take any percentage. You take it as 10%. Take the percentage change in sales as 10%. Even if you take 10, 25, these leverage numbers are going to be same. Okay, so originally we have the numbers as what? Sales 2 lakh, um, variable cost is 1 lakh. Then we have the contribution number as 1 lakh. Fixed cost is 30,000. So we're left with 70,000 as EBIT. Then you pay interest, which is 20,000. Then we have the PBT. So EBIT less interest will give us the PBT value, which is 70,000 minus 20,000 as 50,000 less tax, which is at 25%. So 25% is what? 12,500 is the tax. And we have the PAT as 37,500. Earnings per share is 37.5. Did you get this EPS? 37.5. Did you get this EPS? 37.5, everyone. Your operating leverage, financial leverage, and combined leverage. These numbers should be operating, combined, and financial leverage. They should be operating leverage should be 1.4 1.429. Okay. Financial leverage is going to be 1.4. Combined leverage is going to be 2. Got it, everyone? Combined leverage is 2. Did you get these leverage numbers, everyone? Okay, so 1.429 and 1.4. Always take up to 3 decimals. Okay, fine. So we have seen how to calculate the operating leverage. We will look at some shortcut methods also, along with their derivations. So their shortcuts and derivations we are going to take up after the break. Let's take a break and then we'll come back with the further discussion. Okay, let's take a break, guys. after the break, and now we are going to look for the shortcuts of calculating a operating, combined, and financial leverage. We're going to look at the shortcuts. So, how do we calculate these shortcuts? Okay. So this is going to be calculated. The shortcuts are going to be calculated based on some derivation. So let me just derive one of it, and then other shortcuts we can do it on the similar lines. So here we go with the operating leverage. Okay. So how do we calculate the operating leverage? Operating leverage formula, we say it is percentage change in EBIT upon percentage change in sales. So percentage change in EBIT upon percentage change in sales. So we can calculate this operating leverage as simple percentage change in EBIT upon percentage change in sales. But how do we calculate these percentage changes? We can say this is EBIT 1, which is new EBIT, minus EBIT 0, which is the original EBIT, divided by EBIT 0. So this is EBIT 1 minus EBIT 0 upon EBIT 0 into 100. That's your percentage change in EBIT. Same way, percentage change in sales is the new sales minus the old sales divided by old sales into 100. So we can cancel these 100. And now what we have is EBIT 1 minus EBIT 0 upon EBIT 0 multiplied by sales 0 upon sales 1 minus sales 0. Okay. Now, one peculiar number that we are looking at is the difference in EBIT and the difference in sales. Just look into our original table. What is the difference that you see in EBIT? Sorry, I need to... One second. I need to change this. It's not going to be that way. Percentage change in sales. I'll just revisit it once again. Just missed out one part. Percentage change in EBIT upon percentage change in sales. So if you look at percentage change in sales, it is 10%. Okay, it is 10%. In fact, percentage change in variable cost, percentage change in contribution is also same. So can I replace here, instead of percentage change in sales, I can also say this as percentage change in contribution. So the formula gets revised a bit so that we get some shortcut by cancelling out certain stuff. So it's percentage change in EBIT upon percentage change in contribution. Okay. So that's your percentage change in EBIT upon percentage change in contribution. Now, percentage change in contribution is what we compute as contribution 1 minus contribution 0, the whole divided by contribution 0 into 100. So we simply cancel out the 100, and what we are left is this part. Okay. Now let me just redraft it, and I'll say EBIT 1 minus EBIT 0, the whole divided by EBIT 0 into contribution 0 upon contribution 1 minus contribution 0. Okay. Now, one peculiar thing that I was looking for is the change in EBIT and change in contribution. Just look at these numbers. So change in EBIT and change in contribution. How much is the change? I'm not talking of percentage change. I'm just asking of the absolute change. I'm just asking for the absolute change. I'm just asking for the absolute change. What is the percentage? I mean, absolute change. Okay. What's your absolute change? Absolute change. It is 60,000, right? So can I say the change that you see in contribution and the change that you see in EBIT, they are one and the same? The change that you see in contribution and the change that you see in EBIT, can I say it's just the same? It's the equal thing. So can we just cancel these two parts? Yes or no? Can we just cancel these two parts? Hmm? Yes. So we can cancel out, and what we are left out is just contribution upon EBIT. If you just calculate that for our example also, contribution upon EBIT 6 lakh upon 4 lakh. So if you just try it out, what's the answer? 6 lakh upon 4 lakh, which is 1.5 times. Right? That's exactly what we got. Okay. So contribution upon EBIT, that's 1.5 times. That's your shortcut for operating leverage. Same way, we can get financial leverage. The formula for financial leverage is EBIT upon PBT, or earnings before interest and tax, divided by profit before tax. And finally, combined leverage. Combined leverage is contribution upon PBT. Contribution upon PBT. Just verify these two numbers from our original example. Are they giving the same answers? They should, but just still. They should give you the same answers, but still just verify it. Are we getting the same number? Financial leverage is not same. It is coming 1. Financial leverage is EBIT upon PBT. So it is 4 lakh upon 3 lakh. So 4 lakh upon 3 lakh. So it is your EBIT upon PBT. So EBIT is 4 lakh. And this is, which is 1.33 times. No, you're not going to divide the difference. We should be dividing the absolute values of EBIT and PBT. Are we getting this? Combined leverage is anyways, it's going to be what? 6 lakh upon 3 lakh. This is what? 2 times, right? Okay, so it's pretty simple to understand this leverage, shortcut formula also. Understand that operating leverage is due to this fixed cost. So whatever is above and below that, that is going to be there in our formula. So if your fixed cost is 2 lakh, just before that it's your contribution and EBIT, simply divide that. You get a financial leverage because of this interest. So you just take the number above and below this, which is EBIT and PBT for calculating the EBIT upon PBT for calculating the value of financial leverage. And anyways, combined leverage is just the multiplication of both the operating and financial leverage. Okay, got it? Got it, everyone? Okay, fine. So that's your shortcut formula, your shortcut for financial combined. Okay, shortcut is done. This is fine, operating in there. Now we are good to start with the questions. So let's begin with the questions now. Okay, let's take up the first one. So the first part is finding out the operating leverage from the following data. Sales is 50,000, variable cost is 60%, fixed cost is 12,000. Okay. By the way, after this shortcut, you need not be worrying about, what should be the percentage change that we should look at. Because that percentage change shouldn't matter you now, because anyways, we're going to calculate simply by drawing the financial statements and dividing certain numbers. No need to check for, the changes. We'll upload questions. Yes, I'll be uploading. I think all previous chapters questions are done. Some assignment questions. Okay. And this also I'll be uploading on the portal. So we have sales of 50,000. Variable cost is 60%, fixed cost is 12,000. Okay. So 50,000, 60%, and 12,000. Compute the financial leverage for the following data. Okay. Okay. After the class, if you have, I'll be uploading after the class. Don't worry. Sales 50,000, variable cost is 60%, fixed cost is 12,000. Compute financial leverage from the following data. This is a separate question. So we have to first calculate only the operating leverage. So we start with sales 50,000 less variable cost, which is 60%. So variable cost will be 30,000, and we get the contribution as 20,000 less the fixed cost of 12,000. So you have the EBIT number, 8,000, so which is contribution 20,000, fixed cost is 12,000, so you get a EBIT of 8,000. Now, if I ask you what's the operating leverage, what's the shortcut for operating leverage? Shortcut for operating leverage, it is contribution upon EBIT. That's contribution upon EBIT. So contribution is what? 20,000 upon an EBIT of 8,000, which is 2.5 times. Then, for the second question, for this financial leverage, net worth is given, debt equity ratio is given. Debt equity operating profit is given. So for the second part, we have the EBIT as 20 lakh less interest. Interest is 12%, but then I don't have the amount of borrowing. So I need to first get the amount of borrowing from net worth and debt equity. So we have the net worth of 25 lakhs. And since the debt equity is 3:1, therefore debt upon 25 lakh is 3. So we can say debt is 75 lakh. So interest is not 12% of 75 lakh. So how much is 12% of 75 lakh? So 75 lakh into 12%, that's 9 lakh. So interest is 9 lakh. So EBIT is 20 lakh and interest is 9 lakh. Okay. So we get the 20 lakh minus 9 lakh. So we get the profit before tax of 11 lakh. Okay. So now coming to financial leverage. Financial leverage is EBIT upon PBT, which is 20 lakhs upon 11 lakh. So financial leverage, why is 25 lakh in denominator? Because debt equity ratio is 3:1, right? So debt upon equity is 3:1. So debt is not known and equity is 3. Okay, so financial leverage is 20 divided by 11, which is 1.8182. You're getting EG. What is EG? What is EG over here? 6,25,000. I didn't get what you're talking of EG. Okay, so financial leverage 1.8182. I will getting it. Financial leverage 1.8182. Everyone, are we getting this? 1.8182. Just confirm if you're able to get this. Net worth means equity. Yes, net worth means equity. Okay, fine. Now, yeah, question number 2. Try it. Try question number 2. This one. Try to solve this. You should be able to get the value of financial leverage. PV ratio is something we know. What is PV ratio? What is PV ratio? Can you tell me what is PV ratio, guys? PV ratio is contribution upon sales. Contribution upon sales. Okay. I think rest all numbers you can just use the given data and try to calculate the values.
Variable cost, you have to calculate. It's not given, I know, but you have to calculate the variable cost. Then calculate the variable cost with the given data. Okay, let me start. So we have to get the financial leverage. We know combined leverage is actually operating leverage into financial leverage. Combined leverage is 2.8, so operating leverage is 1.4. We can get the financial leverage as a balancing figure. So financial leverage is 2 times. Okay. Okay, so financial leverage is 2 times. Then we have PV ratio. How? What is how in this now? Combined leverage is a total of, I mean, the multiplication of operating and financial, right? We know operating leverage is what? Contribution upon EBIT. So when you multiply both of them, they get cancelled. If you look at the shortcut, you multiply these two, your EBIT, EBIT gets cancelled. So combined leverage is contribution upon PBT. The financial leverage is 2 times. Now calculating PV ratio and earnings per share. So we have operating leverage, fixed cost is given to us 2.04 lakhs. Now, obviously associated with fixed cost of 2.04 lakhs is the operating leverage. So operating leverage is contribution upon EBIT. Contribution upon EBIT. So contribution is something which we don't know. But definitely EBIT will be contribution minus fixed cost. So operating leverage is 1.4. This is equal to contribution minus fixed cost of 2,04,000. You can solve this and get the value of contribution. So solve this equation. Just solve this equation, given the value of contribution, everyone. What is the value of contribution? The value of contribution after you get after solving this. What's the contribution? How much is the value of contribution? So this should be what? 1.4 times also 2,04,000 divided by 0.4. 5,10,000. Contribution is 5,10,000, and I have to get the PV ratio. So PV ratio is simply contribution upon sales. So we have the sales value 30 lakh. So contribution is 5,10,000 upon 30 lakhs. So what's this number? 5,10,000 divided by 30 lakh is 17%. PV ratio is 17%. What? Contribution is 7 lakh 14. Really? How come? We have 1.4 contribution minus, yeah, right. 1.4 into 2,04,000 is 2,85,600 is equal to contribution. Yes. So this divided by 0.4, yeah, perfect. It will be 7,14,000. So the PV ratio is also going to be recalculated as 7,14,000 divided by 30 lakh, 23.8%. Perfect. 23.8% is the PV ratio. Then earnings per share. How do we get the earnings per share? Now, since we have the contribution number with us, I can definitely go ahead with the EBIT and other calculations. So we say contribution is 7,14,000 less we get the fixed cost subtracted, which is 2,04,000, and we get the EBIT as 5,10,000. EBIT is 5,10,000 less interest. So we subtract the interest. Interest is 21.25. 21.25 lakhs into 12%, which is 2,55,000. We get the PBT also as 2,55,000. Tax rate is 30%. We subtract tax at the rate of 30%, which is 76,500. That is 2,55,000 minus 76,500, which is 1,78,500. That is your profit after tax. We divide this by number of equity shares. Number of equity shares is 1,70,000. We get the EPS. 1,70,000 1,78,000 divided by 1,70,000. That gives you EPS of 1.05. We got the EPS value, earnings per share as 1.05. Then they say if the company belongs to an industry whose asset turnover is 1.5, does it have a high or low asset leverage? Okay, first we need to look at asset turnover. Asset turnover, let's calculate it here itself. Asset turnover, the formula for asset turnover is sales upon assets. Now, of course, assets, it will be same as your liabilities. So I can say sales upon liabilities. So we have the sales of 30 lakhs divided by the liabilities. Liabilities will be your debt of 2,25,000 and equity of 17 lakh. This is 21,25,000 plus 17 lakh, 38,25,000. So we say 30 lakh divided by 38,25,000 is 0.78. So in the industry, for every 1 rupee of asset, the other competitors are generating a sales of 1.5. Other competitors are generating a sales of 1.5, whereas we are generating 0.78. So are we having a high asset leverage or low asset leverage? Obviously, we're having a low asset leverage. Leverage here means they're talking of turnover. There is no specific way of, what is a leverage? We're just looking for the uh, turnover part. So, of course, lower asset turnover. And then finally, we have this question: at what level of sales the EBIT will be equal to 0? Okay. So we need this one. Now we have to do a reverse calculation. Reverse calculation. We want the level of EBIT, or the question says what should be the level of sales? At what level of sales EBT will be 0? Sorry. So at what level of sales your EBT will be 0? So we need to obviously say sales less variable cost Sales less variable cost will give us the contribution, less fixed cost will give you the EBIT. Now, of course, out of this, interest remains the same. Your PAT and number of equity shares needs to be computed. In fact, we want the PBT to be zero. We want to know what should be the sales value. Fixed cost is 2,04,000. So these two numbers remaining constant, which is fixed cost of 2,04,000 and interest is 25,000. And we want to know what is the value of sales if you want the PBT to be zero. So of course, we have to do the reverse calculation. Just carry out the reverse calculation and calculate the sales value is. Try to get the value of sales. Interest is 2,55,000. Yes. Do the reverse calculation, get the value of sales, everyone. Try to get the value of sales. Do the reverse calculation. Variable cost, how to find? Good question. You have to take help of PV ratio for variable cost. In fact, you can get the difference between sales and contribution as variable cost. So, did we get this? So now, of course, if you want the PBT to be zero, EBIT has to be 2,55,000. If EBIT is 2,55,000, the contribution should be 4,59,000. Reverse calculation. Okay. So you should have 4,59,000 contribution, which will give you a fixed cost of 2,04,000. And then EBIT is 2,55,000. Okay. Then how do we get these numbers? So we'll have to take help of the PV ratio. We got the PV ratio, right? PV ratio was 23.8%. So 23.8% means sales if it is 100, your contribution is 23.8. Of course, variable cost will be 76.2. You can just do the reverse calcul, I mean the cross multiplication and get the value. Right? So what is the sales value? If we just do the calculations, 4,59,000 divided by 23.8 into 100. This is 19,28,571. And then the difference is the variable cost, which is 19,28,571 minus 4,59,000. So that's 14,69,571. That's your variable cost. Did you get a variable cost? Yeah, you can place the brackets wherever the subtractions are done so that it will be identified. Place the brackets over here, here, and also here. Okay. Okay. Are you all getting these sales numbers? 19,28,571. Yes. Okay. So that completes our second question. There are a few more questions that we plan to take in one more session. So we have one more session left to discuss about this topic of leverages. Okay. So we'll be meeting again in the next session, which will be the last session of mine. Okay. Fine. So let us stop here for the day, guys. See you in the next class.
Recording stopped.